Welcome to Financial Opportunities Uncovered. Today I'm joined by Jake Barton and Jessica Haltberg. Hey guys.
Hello there.
Hi, good to be here.
All right, so let's just jump into a conversation about how politics affects or weighs on the market. In our previous episode, we gave listeners an update on where we were in the market year to date. So halfway through the year, the S&P 500 is up about 9%. We were down 9% at one point, so up 18% from the bottom. Can you kind of help us understand from a midterm elections standpoint and really, who's in the White House, who's running Congress, how all of that stuff weighs on the market?
Okay. I think that it's really important to tell everybody and talk about how during a midterm election year, we do have a lot of volatility. The reason being is that the stock market does not like uncertainty. Mm-hmm. So we see that volatility peak a little bit before the midterm elections. Mm-hmm. But once the midterm elections are over, mm-hmm. we usually see a rally in the stock market. So it's not anything that people would expect, but the reason is because there's now less uncertainty for the stock market. So mm-hmm. they can now start making plans based on what the outcome is. So I think that's really interesting. Also, the S&P 500 has never had a negative 6-month or 12-month period following a midterm election year. So just very notable right there. I'm sure Jake has some things to add to that as well.
Yeah, I mean, if you look at the whole 4-year presidential cycle, mm-hmm. generally speaking, the second year or the midterm year is the worst of the 4 years.
But is that because of the volatility, or?
Yes, and it's precisely because of this uncertainty leading up to the election. Mm-hmm. Typically, markets just kind of bounce along and don't go anywhere until mm-hmm. right before the election.
Gotcha.
But if you look at it on a quarterly basis, it's the first 3 quarters of that second year that tend to be the worst of the whole presidential mm-hmm. cycle. And then the following 3 quarters, so the fourth quarter of the second year and the first and second quarter of the third year tend to be the best periods.
Which kind of dovetails with what she said about the S&P 500 doing really well.
So this idea of like, oh, the second year is the worst, I'm just going to avoid the market, mm-hmm. that's actually a terrible strategy because mm-hmm. a lot of times you will miss the mm-hmm. upswing that happens right after that.
Mm-hmm. So can you talk a little bit, I know when we're talking with clients about this, one of the concepts that we like to impart is the stock market just goes up, and more or less you need to avoid making knee-jerk reactions based on what's on TV today or tomorrow and who's in the White House, who's in Congress. I like to say that CEOs go to work every morning with one goal in mind, and that's to drive shareholder value.
Yeah.
Certainly there are political impacts that can affect their business, but in general, everybody's eye on the prize. The prize is profits.
Yes.
And that's good for them and it's good for us. So can you share a little bit about, in terms of divided government, who's in the White House, what's the research show us on that? So
I will start with who is in the White House at the time. So I have a really cool chart that I like to show clients mm-hmm. Because it's a big picture, which is what I like to focus on. Mm-hmm. And if you actually look at the S&P 500 through almost every term of every president, mm-hmm. it is ending positive. So
let me stop you right there. So I will have clients say, this president's doing great because the market hit an all-time record. It's hit a record high in pretty much every presidency going back 10 presidents or more.
Yeah, I think that's right.
So that's again because CEOs are motivated to for corporate profits.
Right.
And so, a president can inherit a bad economy, and the economy and the market are two different things, but they can inherit some baggage mm-hmm. or they could inherit the good times mm-hmm. from the previous president, but the bottom line is it goes up.
Right. Whether you're rooting for red or for mm-hmm. blue, mm-hmm. Each president has ended positive on their term and has also reached an all-time high in the stock market during that term. So I think that's just really important for everybody mm-hmm. to know. It's the headlines that we're seeing back and forth that are causing people to not even really understand what's going on in the stock market. So that's why I like looking at that chart and showing everybody. They might say that a Democrat does better during this term or a Republican during this, but at the end of the day, we're all doing what we can. The CEOs are going to work every day and doing the best that they can. And then I guess the other thing I wanted to point out is the divided government. So the stock market actually prefers a divided government.
Since we're talking about presidents, a lot of times I like to talk about how timing is really important for when a president comes into power. I think presidents oftentimes get more credit and more blame than they really deserve in any given period of time. So if I just look back at a few of the most recent presidencies, I'll start with Clinton, for example, in the 1990s. We had a recession right before his presidency in 1991. He comes into office in 92 and then presides over the dot-com boom for the rest of the 90s. One of the biggest run-ups in the stock market.
99 was on fire.
You got it. I mean, you put money in the market in the 90s and you made money.
Yeah.
It was that simple.
And his term ended what year?
In 2000.
Which is when the dot-com bubble burst.
That's exactly
In
right.
our last episode, we talked about IPOs.
Yep.
Pets.com is maybe the most famous one.
Right.
And it's worth nothing.
Yes.
Keep going.
I mean, Clinton absolutely nailed the timing. And I mean, you can credit him or not for that period. But then you look at George W. Bush, who followed him.
Yeah.
Who came on the heels of this giant run-up in the market.
Right.
We then had the dot-com bust.
For three calendar years, 2000, 2001, and 2002.
Exactly.
The market's down like 30 to 40%.
Something like that. I mean, a big collapse at the beginning of his presidency.
Yep.
And then you have the 0809 financial crisis that
very
happens at the end of his presidency. So if you look at George W. Bush's presidency, it was actually negative over his 8 years. To Jess's point, though, we still hit all-time highs during his presidency. It's just right at the end that the market collapsed. Kind of keep carrying this forward. You have Obama coming after George W. His presidency picks up right at the bottom of
the recession.
And even though it was kind of a slow, grinding recovery, over 8 years, it was one of the largest recoveries we've had in history. So
I think the Dow was at 6,500 points.
Yep.
At its lowest point, 3 months into Obama's term, and I don't know where we finished, but it was probably 14,000 or so.
Yeah, I mean, I was just going to add too that from an investment philosophy, it's not about timing the market, it's the time in the market. So we don't want to be making these changes based on if it's a Democrat or a Republican in office. We want to stick to our long-term plan, and if we need to make adjustments here and there, we will. But it's like I said, it's the time in the market, not trying to time the market.
And for people that just want to know, how did the market do under Republican presidents versus Democratic presidents? You have the Dems at about 7% average annual return. You have the Republicans at 6.7. That may shock some people. However, at the end of the day, they're both really good, and they're within 3 basis points of each other.
Exactly.
So,
the best returns come when you actually have split government, not a single
Right.
party controlling.
Right.
Yeah.
Let's kind of take things back to this year. Here we are, 2026, midterm election year. A lot of folks in the media would argue there's a lot on the line. How do we look so far?
We kind of referenced it earlier. We said that the market is up year to date 9%, and we've been down 9% as well, right? So we're up 18%. That actually does not align with the previous midterm election years.
It's better then.
Yeah, we're doing a lot better. We're a lot more positive. So I think coming into these summer months, getting closer, we will expect to see a little bit of that volatility that we're used to seeing. But I think it's where we are right now is not the norm. So people might not be ready for that volatility that's coming. So I think it's just important to be reminding everybody of that.
Also, as I think about 2026, it's hard to not compare Trump's second term to his first term. And you look at 2018, which was the first midterm election of his first term, and interesting corollaries happening there. So in 2018, the market was up 10% over the first 3 quarters, and then we had a 20% down in the fourth quarter of 2018. Big drop right at the end of the year. Not typically what you see in a midterm election.
And we finished the year negative.
Finished the year negative.
Slightly.
Right, and then you had a pretty sharp rebound that happened after that. But largely, economists attribute that to a misstep with the Federal Reserve, not necessarily from the president or from Congress.
Okay.
The Federal Reserve was raising interest rates at the time while people had worries about the economy starting to slow down. You had oil prices falling. So there was just a lot of concerns about the economy in tandem with rising interest rates. And so you had this quick reaction.
Okay, gotcha.
I also like to look at 2022 because that was our most recent midterm election year. Another negative year for markets. That was another midterm that did not follow the trend. We were actually down about, I'm going to check my notes here, it was down 20% over the course of 2022. And you think about what was going on in 2022, that was the start of the Russia-Ukraine war. So we had a supply chain crunch with oil.
Yep.
Not too dissimilar from what we're experiencing right now with the Iran-U.S. conflict.
High inflation.
Rising
rates.
inflation,
Yep.
we had rising interest rates, and a lot of corollaries again to what's happening this year. The Federal Reserve widely expected to start raising interest rates because of persistent inflation, and we've got this oil supply problem. So yeah, I think the recent midterms could actually be an interesting corollary for this year.
Jake and Jess, thanks for joining us. And as always, we thank our viewers. Thank you for watching Financial Opportunities Uncovered, brought to you by Keeler and Nadler Family Wealth. If you'd like to connect with us, you can connect with us on LinkedIn or shoot us an email at info@knwealth.com.
The opinions expressed in this program are for general information purposes only and are not intended to provide specific advice or recommendations. It is only intended to provide education about finance, tax, retirement, and related planning topics. To determine which investment strategies are appropriate for you, consult your finance, tax, or legal advisor prior to implementing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal. Please seek advice from a licensed professional. Keeler and Nadler Family Wealth is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Keeler and Nadler Family Wealth and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Keeler and Nadler Family Wealth unless a client service agreement is in place.